Okay, good afternoon and welcome back everyone to another edition of the Market Playbook with Tony and Jess. And today we have a very special guest, Rick Bensignor, our Chief Market Strategist, will be joining us today talking about markets, talking about earnings season, talking about inflation and rates and our views on the markets. So with that, let's go ahead and get started. First of all, Tony, Jess and Rick, thank you so much for joining us.
Let's see. Where's my camera? Do you see us? Because I don't see us.
I see you, Rick.
See you both.
We are there.
That's cool because my screen must be showing me who's ever speaking because now I only see Jess.
Oh, okay.
Well, you're both here. Thank you so much for joining us. This is going to be another fun event like we do last time. And we're going to go over quite a bit. But before we do, what we are going to discuss today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we're going to discuss during today's session. Now, before we kick things off, we've been doing these polls every single time. So I'm going to launch this poll here once again. We're curious as to where do you see the equity markets in 1 week's time? Higher, lower, or you are not sure? Last week, we had quite a few investors feel that markets are going to move higher. This week, things seem pretty split. 33% of you say higher, almost exactly the same number of you say lower, and a third of you say you don't know. Rick and Jess, I think this really speaks to the, how investors are feeling right now in this market. We don't know which way to go, right? We've seen a lot of strength here on the back of earnings. July was an incredible month from a market perspective. August so far looking quite strong as well. There's certainly gotten a lot of bears to reconsider their shorts, and a lot of bulls licking their chops, thinking that this has some legs. So I think we're going to discuss all of those things to understand where we look at the markets and kind of our views on some of the ideas. So let's jump right into it and let's take a look at the broader markets. Rick, you have made the call in early June with respect to a bottoming in the markets. You had called 36.17 in the S&P 500. We got to within 0.5% of that level. And we've seen a pretty substantial rally off the back of that. And you have some thoughts as far as how far we can go, and specifically some of the key levels for how far we can go, and also where we perhaps change our views. So why don't we start there and get your take on what do you think, where do you think equities are? Does this have legs to go a little bit further? And what do you do once it gets to those levels?
Sure. So in the general sense, Tony, I think that a lot of this move is coming from positioning that exists in the market and the unwind of shorts that are getting squeezed to the upside now because of the way the bottom was made. I said before, I think I did it even in Monday's weekly market, the technical market outlook that I do Monday mornings. If you look at this chart and you take a look at the week that made the low, which was down right against targets, 36.73 held, that was a propulsion exhaustion target. 36.17, as you said, was 0.5% below a target I had put out. I think it was in March, we put down 36.17 as the downside target. If you look at the subsequent 4 weeks to how the market bottomed, you'll see almost 4 exact same lows, which means there was a ton of selling, and yet the buyers were able to absorb all that selling week after week. Whatever came in, they essentially made a stand. And then once we popped through the weekly conversion line at 39.07 in that pink colored line, on what we see as bar 2, that's the first sign that things were potentially changing. And then last week, of course, you had the big move up, which notice also bottomed at 39.07 and then went all the way up to the baseline at, what was that, 41.37 or so. And we closed essentially right there. Now we're starting to get into the beginnings of more substantial resistance, but I think we actually still head higher So many technicians are going to look at right where we are now as resistance. Look at the horizontal red dotted line at 4164. That's a TDST line that goes all the way back to July of 2021 on the weekly chart. It caught the lows in February and March. It caught the highs in May. This is kind of a flipping point, you know, above it's bullish, beneath it's bearish. So you're going to see the most confirmed bears selling here against what they would anticipate to be decent resistance. I'm in the camp that the squeeze to the upside is not done. So we certainly could pull back from here, but nothing major. And I think we're going to head towards initially that kind of cyan blue colored level, right? Kind of 42.94. So the bottom of the cloud starts at 42.70. And then 42.94 is that hyphenated green line, which is the bullish propulsion momentum level. So you've got to properly get above that to essentially get the sense that the pure bear market is over. I'm likely, and I've said this before to our clients here, that I'm likely going to start using in and around that 4270 to 4300 level to start selling into, not necessarily just putting on pure short trades, but really more positioning my own portfolio, and of course clients who follow me, to use anywhere from, let's call it 4270 up to about 4500 as the place. And so that 230 point range as the place to do significant selling in your portfolio. If you notice, the top of the weekly cloud right now, which comes down over the next 2 months or so, but the weekly top Bollinger Band is just above that. And even if we rally now, chances are that Bollinger Band is going to continue falling, such that by the time we get to if this market moved to the top of the cloud, you'd also likely be dealing with the top weekly Bollinger Band. And that to me is about as much as this market's going to go to the upside. So I'm not highly confident that the March high gets taken out. If it does, it may be on an intra-week basis, but I don't think we're going to close above that March high. And I still think, we'll talk about it now over the coming minutes, that there's enough issues out there that this market is not just simply having turned around, pivoted recently, and we'll talk even about this supposed Fed pivot, which isn't, and that this is just going to come back and take out the highs the way the mega bulls think we're going to.
Thank you so much. And I think that's really interesting, because a lot of bears have been selling into this strength here. You know, I certainly have taken a few shots at earnings plays that I thought would fail, especially given the, you know, some of the guidance that we've seen from companies prior to earnings season. You know, Apple and all of the tech companies saying that, hey, we're slowing hiring. That was a pretty radical shift in terms of messaging from the tech companies. And I had taken a few shorts. You know, I've closed out most of those shorts at the moment. You seem to think that this has a little bit more legs to go. Jess, I'd love to hear your thoughts as far as, you know, do you agree that this is a bear market rally, and that as we see a little bit more strength, that this is an opportunity for shorts?
Yeah, I do agree that it's a bear market rally. And I love the cloud model. I think it's really great for points of support and resistance. And I want to build on what you said in regard to the tech earnings, because we talked about this earlier as well. With the tech earnings, it's very interesting that they were gauging on a health of the consumer. And from a tech perspective, if you think about the data that they have to understand if there's a slowing economy, it was a very different picture that we received from the Biden Council, with all of the senior executives like Brian from Bank of America and Marriott and Deloitte and such, that were actually speaking to the health of the consumer. So it was a really different message. But I think there's strength and value in understanding the tech perspective, because it makes up such a large percentage of our indices now in comparison to previous markets. And like the study we did and what we talked about a few weeks ago, is those sectors that really lead bear market rallies tend to be the laggards, and that is tech. Tech is the one leading the decline, and also leading the rally. Therefore, I think there is some weight within what the tech executives are saying. Definitely, there is value in what was said during that meeting at the White House. However, I think it's just interesting, the messaging, and then that plays into consumer sentiment and perhaps what helps this rally that is going to be exhausted at some point.
And thank you so much for your thoughts on that. And we know that the if we look at the bigger picture here, the pullback that we've seen here in equities is on the back of higher rates. And Rick, you had shown us a chart here of rates a few weeks last week and over the past few weeks of the head and shoulders that we've seen in TNX, and we were concerned about a potential pullback down to as low as 2.3 on the 10-year. I think that view at this point, you no longer are currently expressing that view, because you actually had a TLT trade this morning. Your view is that the rally we've seen here in bonds over the past, call it 8-9 weeks, that could be potentially coming to an end. So let's talk a little bit about rates and your view on kind of bonds and rates,
Right,
and how that affects your view here on equities.
sure. Can I grab the screen?
Please.
Yep.
Okay, so let's okay. So let me pull up a TNX chart and show you both the daily chart and then the weekly. So the daily chart, we specifically said, look for a potential false breakdown, because remember, we've been talking about 2.7 to 2.58% as where the support really is. And I had a feeling that you were going to see people sell this potential breakdown and that it could easily hold into 258. And it did. Intraday, we got down to 2.52 on the low yesterday, but notice where we closed and notice what we've done today. We're back, both days we're back above the neckline, and we haven't broken to the upside, but we're back above, which means this never broke. So only if we had really properly broken, and certainly yesterday showed that we did not at all, then you had the targets down at 2.36. But let's look at the weekly. And the weekly, it's harder to see that kind of head and shoulders. In fact, the lagging line gives you almost a better sense of what was showing up in the daily. But the weekly held the baseline, at least. I mean, today's only Wednesday, so we're not sure how the week's going to close out, but I suspect that 258 is going to hold, and that we have a chance to see rates creep back up and possibly play with the conversion line over the next several weeks. So I'm not looking for rates to make a major move up, but I think we can get 2.95 or 3% again, Tony. And on the week that we made the high for the years, we call this as the high. And when you bring back some more data into view, and we pull and look at that 3.25% level, which was the last high that the 10-year made before diving to all-time lows, we saw two combo signals before we caught the bottom. And in real time, I had my clients buying this in yield terms, selling bonds at the all-time lows. We got the second move, the same exact inverse signals on the way up. The second one was the high. And the week that we made the high and got to 2.46%, yields actually closed just a tad under the 3.25 level. And they have yet to come there since. So 3.25, people are going to say, oh, the high is 246. It might be on an intraday basis, but the 3.25 level has been a line in the sand that held perfectly. This has been just beautiful. For traders, this has been great. If we take a look at TLT, which is somewhat, but not exactly similar, because this is more of a 20-year bond proxy as compared to the 10-year. What we saw today is, again, a bounce on the trend line. But when I looked into the fact that rates just bounced and are likely moving higher, TLT surprisingly traded up today, but I actually think they're going to trade lower, and this trend line in green is going to break to the downside. So I kind of took a deep look into yesterday's price action and where we could potentially run out of steam on the upside today. So we leaned into a rally and put on a TLT put spread today that was conditional based upon us getting to 118.5 to 119 in TLT. And we did. You'll see it close at 119.5. So I don't need to risk much on this. If we close, we get one or two closes above yesterday's high, I might say, okay, it's not going to be. But I don't mind leaning into this for the chance that rates right now fooled a whole bunch of players in the last 48 hours and are actually holding up. And if rates start to just creep back up, having held the bottom of the range, then we're going to see, or should see, TLT trade down.
So just for those of you that are members of OptionsPlay, we had a conditional trade. We were buying a put spread here on the fact that if TLT traded between 118.5 and 119, that did satisfy about 30 minutes before the close. So that is certainly something that is now an active trade. And I think the key here, I think from my perspective, Rick, is the risk to reward ratio on this particular trade. You're targeting around 114 here to the downside, right?
Something like that, yeah.
And entering this trade at around 119 and exiting the trade if it gets above 120.5 means you're risking a little bit more than $1 to potentially make a little over $5 on this particular trade. That's the risk to reward that we're seeking on these types of trades. And I think that's really important to highlight, because we all have ideas, right? And one idea is not necessarily better than the other, but it's about making sure that the risk to reward ratio is as skewed as possible in your favor to better your outcomes on these types of trades. And that's something that, Rick, I've learned a lot from you, and I hope that for those of you that are watching today can take something away, not only from the idea, but also the trade setup itself. And Jess, I know you have some thoughts around inflation and Fed speak, because that ultimately is what drives rates and certainly has an influence on rates. I'd love to hear your thoughts on that.
Yeah, and I do want to echo what you say. I think there's so much to learn from Rick, and I think he's a great asset to the team. So that risk reward is just ever so important. But in regards to inflation and the Fed speak, and I think something that's certainly very interesting is if you pull up the market's anticipated movement of rate hikes, they are really looking for a pivoting dovish Fed. And I don't think I necessarily agree with that. And I'll give you my reasons as to why. If you look at the past Fed reactions, it is very data driven, which is great. I appreciate that. And I think anybody who's analytical absolutely loves that it is, but there are surprises. And we have 2 CPI numbers and other data coming before the next Fed meeting, in which case there is too much data to digest to suggest a pivotal Fed going dovish. And in addition to that, there's just so much information that we absolutely have to digest. And I think that's important in regard to the inflation concerns. And I did lose my train of thought there, and I got it back. When Fed Powell initially gave his last meeting notes, there was indication of that because he very carefully avoided the words recession and things of that nature. But this week, there were 2 other Fed speaks that kind of normalized that and said, hey, let's take a shift back. And so that helps with what I believe was some of the sentiment changes that caused the market downturn, in addition to some of the China concerns. So I think that's important just to be cognizant of in regard to inflation, what the market's pricing in, and what we're all saying and echoing Rick's sentiment and Tony's is perhaps this is an exhausted bear market rally, and then we can utilize technical analysis and the levels that Rick has suggested just to pinpoint exactly where that is due to all of the moving pieces, if you will.
Thank you so much. And, talking about recession, I do want to pivot a little bit because, we've looked at the US markets quite a bit. And, but one thing that came on my radar is looking at some of the economic data was really looking at Europe, and it really surprised me, or sorry, it's not really surprising, but when you actually looked at the data, it really just showed how poor the economic data coming out of Europe was. As much as the US data coming out of US is not as bad as I think a lot of people might think it is when you look at the headlines on CNBC and Bloomberg. But when you look at the European economic data, it's quite concerning. You have Italy, Spain, Denmark, Czech Republic, Poland, pretty much every of the major countries around the Eurozone, their manufacturing data has come in negative, meaning contraction. You look at German retail sales, contracted 10% last month. These are some of the numbers that are, surprising us to the downside. And I think that when you're looking for bearish opportunities, not only are there opportunities here in the US, foreign ones like Europe, I think is perhaps even a better one at the moment. So one ETF that I'm paying attention to here right now is IEV, which is the iShares Europe ETF. Rick, I'd love to pull up that chart and take a look at it, because we certainly have a rally, just like the equity markets we've seen here in the US, but certainly not to the same degree we've seen out of the S&P. If you look at IEF relative to the S&P, we've actually seen what looks like a new low print. So this is one that I'm looking at as a potential short. You have some thoughts as far as where you think you might want to enter that short, and I'd love to get your thoughts here.
So here's the relative chart, which first time I'm looking at it, just on a pure side-by-side basis. So you've still got, we're slightly above the highs, the lows made in February. You're starting to see some exhaustion signals show up too. So I conceptually agree with you that Europe's in a lot more hurt than the US is, both economically on their own, on an individual country basis. So the Eurozone itself is in far more trouble, but they're also having to deal with the Russian-Ukraine war in a much more kind of personal way than we are. And it affects them far more than it affects us. And, we already know about Russian shipments of nat gas being greatly curtailed. And if they were to cut off completely, they've already down to, I think, knocked it to 20% of what it had been. If they go to nothing, Europe is going to be in a dire condition. So it'd be interesting. I don't want to put the trade, just looking at this because of the downside exhaustion signals, I don't want to put the trade on necessarily right now, but this is something I would certainly watch over the next month or so to see whether or not we keep going down. And if there's any move back above that February low, if we get a quick move down and come back, then you might be able to actually think Europe, for whatever reason, just off of the charts, would outperform. In general, I would stick with the idea that they're not going to do as well as the US. And in general, I'd probably be thinking of, long S&P versus short IEV or FES, which is the Europe, the Euro Stocks 50, same type idea. But this chart actually would definitely have me take a stop and rethink that. And, markets figure this stuff out before the fundamentals get known publicly. So I like the idea, but simply because of what I'm seeing on the chart, I don't want to put it on now, but certainly this is something we should watch going forward.
So let's pull that chart of IEV back up, just the absolute chart of IEV. And you had mentioned a couple of levels to pay attention to. One, you have, at least on the daily chart, some massive gaps that have not been filled. And you also mentioned a downtrend line to pay attention to, which corresponds roughly to the top of that cloud. So those are some of the levels that I think, if we start to see a little bit further strength here in IEV, those are potential entry opportunities for Europe.
Yeah, I mean, this is off the two highest points. There's actually kind of an interim one that's just a bit lower, but they interestingly merge in the future. So the big gaps all came in early June, where in a matter of 3 or 4 days, this went from being a $48 stock to a $43 stock. So a very significant fall in a quick amount of time. We've already filled the first gap on the move back in June. We then make lower lows. We've come back. And now we're just starting to get into some of this gap, but it doesn't fill until you get to 45.38. So we're not done there. And my guess is even with the 9 count, my guess is just from some of the trading, back and forth trading, we could. What you want to see is this stay above 42.07 on pullbacks, such that it has the chance to essentially still test and or even break the downtrend line. You could break the downtrend line, get every Tom, Dick, and Harry on CNBC telling you this is on a breakout and it's going somewhere, only to stall against the propulsion exhaustion level, which doesn't even quite fill the gap from June. So right here, same thing. I want to watch this. I want to see if it pulls back, where it holds to, and whether or not we continue higher. As of course, if the rest of the market, continues higher too, because this bottomed in the middle of June, essentially the same time all the major global markets bottomed, and have been moving higher. So this is somewhat in line with everything else we're seeing near term.
Thank you, and I think this is really helpful in terms of understanding, if we get a little bit higher, what levels to start looking for, and this aligns with the broader views that we have here with U.S. equities as well. So with that, I think I want to jump back to U.S. equities and kind of the earnings season that we have had. And I think for me, the most surprising data point coming out of this earnings season, given the fact that 80% of S&P stocks have reported now, the season on EPS wasn't particularly strong, but certainly better than I think analysts were expecting at the beginning of the quarter. But the one thing that really, the one metric that I track very heavily that influences my views of the broader markets is how stocks react to when they beat earnings and how stocks react when they miss earnings. We tend to see near market tops. You see big surprises to the downside. And market bottoms, you see big surprises to the upside or big moves on surprises. But what was really different about this particular earnings season, and I honestly don't know the last time, I'd have to go back pretty far to find out when the last time this happened, but the average stock that missed earnings moved higher by 1.2%. 1.2%, first of all, is a pretty big move on average 2-day move, even for stocks that beat. But this particular earnings season, stocks that beat moved up 2.9%, 290 basis points. That's about as high as I've seen in a while. And stocks that missed not only didn't move lower, it moved higher on an average of 1.2%. So I'd love to get both of your take on this, because traditionally looking at that type of data point, you would say that when bad news causes markets to go higher, that's a good sign that markets are near a bottom. And I'd love to hear your thoughts as far as why is that not a reason that we should now all be buying equities?
Jess, you go first on this one.
Love this
pass this
question.
to Jess first.
Sure. I think it goes back to what I was saying earlier. I think that if you look at the study of bear markets and just looking at past history, they tend to end or really go into rally mode when the Fed stops raising rates. And so I really do think that this thought that the Fed was going to be dovish artificially inflated the market more. In addition to, we were expecting a bloodbath, and perhaps the earnings weren't as bad. They were bad, but not as bad. So it's that markets are forward looking, so they priced in something a little worse and it wasn't, so therefore we rallied. But then it also worries me is when you move too much too quickly, then that is not a valid move. So I don't think it's bottomed yet, because a lot of the other aspects in market data that we need to see and the reasons why the market is going down just hasn't happened. It doesn't make sense, to be honest. I would love to hear your perspective, Rick.
Well, I think that you've got so many elements at play right now in the market for investors to have to deal with. The big macro issues that have been overhanging the market for quite some time. The fact that the Fed is no longer dovish and injecting money into the system the way they have for years and are notably hawkish. I think, and I said this immediately last week, that the market, the investors got this wrong about the Fed's intentions and what Jay Powell's, how they interpreted his press conference last week, and that there was going to be a pivot. Every single public thing I've done since then, which includes multiple written articles and several webinars, I said it's the public's, investors have this wrong. The Fed is not done. And I figured it would be closer to the Jackson Hole meeting that Fed officials would start coming out to say, you guys totally got the interpretation wrong. 3 or 4 of Fed governors yesterday said, you've got this wrong. And yet the market held on and then just added another 1.5% today. So that's also telling you, if the rally came from this supposed Fed pivot, and now the Fed tells you they're not pivoting, and yet the market is still rocking to the upside, there's something else at play here. And I'm not sure what it is, other than the positioning was so bearish. Sentiment numbers got to the lowest level we've seen in 15 years. And I don't even give a heck of a lot of credence to the AAII poll, but even that had been almost this entire year very bearish. And there are other technicians that have commented earlier this year saying, the public is so bearish, it must be the bottom. And I wasn't in that camp until we got down into that 3,600 level, that somewhere between 3,600 and 3,700 as being where I really had strong feeling that that's where this market was going. To flip things on the upside now, I think, and I wrote this to an institutional client today who was saying, I don't get what's going on. I said, I think the marketplace has been so bearish that you've got to balance out and get bulls and bears, somewhat equal now, if not even slightly bullish, and wash out the shorts and really put pain into the shorts, which means we go over 4,200 and maybe even over 4,300 in order for them to go, oh my God, I've got this wrong and I'm losing a boatload of money and I better get out to save my year if I have any chance to do that. Then and only then will you not have a short base left to the market in order for the market to actually fall, when the realization then again comes into the mind that earnings are still probably not done being adjusted lower by analysts. Inflation is not going to drop from 9% to 3% in a snap of the fingers. And you don't have a Fed who is in the mode of easing. People took this as that they're easing simply because they thought they may not keep raising rates. That's not easing. That's just not doing what you've done at the same degree that you've done. But I am not convinced, Fed funds now 2.25%, 2.5%. I don't think they're done until 3.5%. So whether they do them in smaller increments or just one more painful 75 bip, then they may be done. But that doesn't mean they're in easing mode at all. So I'm looking for the market to kind of find more of an equilibrium point somewhere in between this year's range. And the higher we go, the more I think that when we fall, we may not fall enough to take out the low from June. So to me, it also depends on where the peak comes from, whether or not that June low comes into play or not. I'm not sure we're going to take it out. If we get up to 4,200, 4,300, I don't think we're going back under 36, 36, 37 this year.
Rick, your contrarian views are always greatly appreciated. And I think that is truly where your insights are different from everyone else on the street. And we really appreciate that. And I think this is a good time for us to pivot towards the last thing we want to talk about, which is actually a preview for those of you that are members to our daily play for tomorrow. This is a stock that is not loved by analysts. I was looking at this before we got on. I was taking a look at just how hated this particular stock is. And then this really speaks to kind of the contrarian views that Rick, that you have. And I think that very much this is kind of where you can find some of your best ideas. Only 39% of the street has a buy recommendation. Only 2 analysts out of a large number have a buy rating on this, or 12 rather have either buy or strong buy. Quite a few sells, 16 neutrals. Rick, why don't you introduce the stock that you are starting to pick at now that it is so hated on the street?
Yep. So let's take a look at none other than boring AT&T. This has been, so in my 40 plus years on the street, this has always been the single name called the grandma name, because they pay a nice dividend, and grandmas like to have a stock that isn't generally very volatile, and they just can collect money every quarter from a check. So they had terrible earnings where they're trading virtually on the lows of the last several months. But here's the thing. There's three things that caught my eye. One is the uptrend line from the December lows, which is their cyclical low, is just above, it's about, I don't know, let's call that $18.15 or so right now. It's going to move up. That's the purple line, right? So it's just beneath where we're trading. Then I took a look at whether I draw this line here across prior highs from March. I could even take one just a tad lower against all these highs, but they're almost exactly the same. So in this zone here, I've got kind of multiple reasons to think that the market, this particular stock, could be done going down, as well as the fact that it closed the gap to April, right? So we had a big gap, double bottom, triple bottomed against the gap, came back to the highs, and now sold down and finally filled the gap. So that's now three things of why this could be done going down. And then the fourth, and potentially the most important in my view, is that we've got a downside exhaustion signal here from the sequential model. Now, it doesn't have to stop right here, but it certainly tells me I don't want to be a seller anymore. And when I put all these lines together and the fact that we filled the gap, I'd be willing to look at this in two ways. You could either simply just sell an at-the-money call, an at-the-money put, and collect the premium. And you could do either an 18 or an 1850. I don't think they do quarter cents, quarter dollars on this. So I think it's an 1850 we're probably looking at. Collect the premium. And if you get exercised, you could simply buy the stock and look at this as not a bad place to own AT&T in the scheme of things. Alternatively, if you're not interested in actually buying the stock, but do this as a more hedged put spread, you could sell the 18.5 and buy a 17.5. And the reason I'm kind of picking 17.5 is because the stop out level to the sequential signal is at 1783. So even there, I can give it a little leeway against these lows and here's and say, if you get under 17.5, okay, so then maybe I don't want it. So we'd risk $1 in the sense of the price movement. That's 6% of the price of the stock, to play for the fact that this could easily bounce from here and has enough counter trend signals for why there is actually support here to make me think this is worthwhile doing. You could also, I guess, in theory, buy a call spread, and with the VIX down low, you could approach it that way too. I initially thought of this as selling a put spread because, or just selling the put, because I wouldn't mind owning the stock down here if I got exercised. So that's, we can lay this out or talk later, Tony, about how we exactly want to make this officially the daily play tomorrow, but at least you guys have a sense of what I'm looking at and how I come up with some of these ideas and how over time I create an edge in the market that most other forms of analysis don't give you. Because when you're playing in the middle, let's say this moved higher and all of a sudden the stock's at 19.5, 1975, somewhere in here where my cursor is. And you say, okay, well, it held, let's buy it. You have a very hard time to figure out how to manage risk on a trade like that. You're in the middle of price action that goes back for months. You have absolutely no edge in the market doing that. It may work out, but you have no edge. You'll make money because the market dragged that higher. But when you play the extremes of the market moves, which is what I consistently have done for 40 years, it's a much tougher game, and it takes years and years to master how to do this and how to place your stops and where to place them. But when you approach the market that way, you have a much better chance of having an edge and actually outperforming benchmark indexes, because in theory, you're actually doing what you've been told to do since day one that you ever got interested in the market, which is to buy low and sell high. And of course, 99% of the people have no clue how to actually do that. In fact, if anything, they tend to buy high and sell low. My approach is exactly the opposite, and it is proven over time to be not only effective for me, but the smartest money managers on the street are doing that. They're not doing basic technical analysis, if they're even doing it at all, but they're certainly not looking at an RSI and saying, oh, RSI is moving up, I guess it's bullish, let's buy. That's not how they're making money, and certainly not how they're outperforming.
Well, Rick, I certainly think that your 40 plus years of institutional knowledge is extremely, and I am extremely grateful for having insight into this, and very much looking forward to doing more sessions with you like this. For those of you that want to find out more from Rick and Jess and I, you can find us here at OptionsPlay.com. If you want to sign up for a free 30-day trial, you can do so, and follow our trade ideas like this AT&T trade, which we will be sending out tomorrow morning with the specific trade setup on this. And I just want to spend 2 minutes talking about that. You talked about selling a put spread here on AT&T. You know, especially with the chart setup that you have here and the different levels that you're referring to, I'm even, you know, especially on a low price stock like AT&T, you know, selling just an outright put option will only cost you about $1,800 per contract in order to sell a put option. That gives you the optionality to buy the stock. You're going to collect, in this particular case, about 2% of the stock's value by selling a 30-day put option. Just to put that into context, that's about a third of the dividend yield that you're going to collect in just 30 days. You right. AT&T pays about $1.60 in dividends on an $18.5 stock. That's about a little over 7%. Here, you're going to collect a third of that in just 30 days. So that's kind of how I'm looking at these types of plays and thinking about how do you then, in addition to the technical work that Rick's doing, overlay options and the high implied volatility that we're currently seeing with AT&T options to even put the edge further in your favor. So with that, I think that covers what we wanted to share with you here today. Both Jessica and Rick, thank you so much for joining us this afternoon. This was really, really insightful on the broader markets and how you both think about ideas and finding not only ideas, but the best ideas, the ones that give you that edge. So Rick, thank you so much for your insights there. So with that, what we'll do is we'll open this up for a few minutes of Q&A, and we'll try to answer a few questions before we sign off on today's session. So there's both the chat window and the Q&A windows. If you don't mind, type your questions into the Q&A window, and we'll try to answer a few questions before we sign off. And while you put in your questions in the Q&A window, just a reminder, you can sign up for a full 30-day free trial for Rick's Monday morning session, where he gives you his macro technical view of the broader markets. You get our daily trading signals put out by Rick, like the AT&T trade that we'll be sending out to our members tomorrow morning. And you get access to weekly education sessions that Jessica and I host on option strategies that you can utilize in these types of scenarios. With that, let's take a look at the questions, and both Jess, Rick, feel free to jump in if there's anything that you feel is worthy of answering.
Sure thing.
I'm actually going to handle one from Randall saying, I read Nicole Elliott's book on Ichimoku, which is cloud charts. And in it, she says that the cloud model was designed just for use on daily charts and not weekly charts. Have you heard that before? First of all, no. Secondly, even though Nicole came out with the book when she did, it has been said by many that in the Western world, I am the most knowledgeable expert on the cloud model. I've taught it to more institutional clients than anyone. I've turned down 3 book offers to do it. And actually a presentation that I made in 2004 in Madrid, Spain, had a chap from London see it. And he came to me, I explained the basics of cloud charting. And he came to me afterwards and said, you know, you should write a book. And I said, no, I'm not going to do that. He says, well, if you don't write one, I'm going to write one. I said, go to it. And he did. And he even went to Japan to try to find out as much as he could. And I will tell you that it's probably the best book out there, better, in my opinion, better than Nicole's. But it's still just the basics of cloud charting. And there's far more to it than meets the eye. And that's part of why I chose not to write a book on it, because it's a huge competitive advantage to know what I do know about it that others don't. But to answer your question, no, I've never heard that it's only for daily charts. I have used it. I'll give you here, if I can share this, can I get the screen back for a sec?
Oh, of course.
Okay, I want to show you guys something when we talk about which time frame and stuff. So take a look at which one. Oh, it's Kathy Woods's ARC on a monthly chart. Okay, so here's the monthly chart. Not only did I have a
Rick,
reason.
you're not sharing your screen yet.
I'm not sharing. Okay. Let's see. Share screen. Sorry, guys. There we go. There. How's that?
Perfect.
Okay. This is total trading history of ARKK, one of the most publicly owned and to many unfortunately owned names out there. We have a monthly 9 count down at the lows of the year. We have essentially, look how far back you can go with approximate support level at the mid to upper 30s. Put on a monthly cloud chart and look at the last 3 months and what's happening now. I got my institutional clients long this at $40.23. That is her entry. Monthly TDST line, 39.41. Bottom of the cloud just beneath there. Weekly chart had a TDST line at 40.23. 3 months in a row from top of the cloud to bottom. And we're still in the cloud. But I said, I'm never going to come up with a better entry in this name than paying right around $40. And now it's trading almost $50. And I even have in the no trader clients in this. So this is something that, this is cloud charting way past the daily time frame. You can use it. I don't use it intraday, different story, but weekly, daily, monthly, you've got to know where you are in your cloud setups. So I know that was a long answer, Randall, but I don't think Nicole had that right at all.
I don't think anyone minds the long answers, especially when you have some fantastic visuals to go along with that. There's a question for me regarding the Apple short position that I put on. I think this was a couple of weeks ago on CNBC. This was one that I put on when Apple was going into the earnings announcement. I was expecting that earnings announcement to come out worse than it did, and we had put on a call credit spread, the 155, 165. Now that Apple's trading above that upper strike, I believe it's time to cut losses on that particular trade and move on. So for those of you that are asking for an update on that, hopefully that gives you your answer.
Mm-hmm. I do see one, and I apologize, I haven't watched the economic data today due to how busy Tony keeps me. But the high-end consumer spending is going to slow, and what impact that will have on the entire market. That actually is a good sign, because that's the purpose of raising interest rates, is it's demand destruction, right? So if the Fed, that means the Fed data is working. So that's actually a very good sign if consumer spending is slowing, because that's the purpose of raising interest rates, isn't it? in addition to many other things. And something we didn't talk about, and that is totally apologies for putting that in the description and talking about recessions in general, so we can hit on it very, very briefly. The definition of a technical recession is GDP reporting down 2 quarters, which happened. But the people who call a recession is the NBER. And if you actually even read their description, it's much more complicated than that. So it's not necessarily a recession yet, but it's more of like a chess movement game rather than just black and white. So just know that there's a lot more components involved with it. It's just consecutive economic downturns, and there's a lot of other things contributing to high inflation and looking at growth and a record low unemployment right now in the hot labor market, and that contributing to inflation. So it's just too many things to call it just yet, if you will.
I see a question here from Paul regarding growing a small account and being cautious, trading only one options trade every 45 days. So Paul, I think what you're referring to is if you were to place a trade and that trade, is risking a relatively large percentage of your portfolio, that you wouldn't want to put on multiple trades like that. A few thoughts there. One, you might want to focus on stocks with relatively low prices so that you can potentially put on multiple trades at once. But as long as each trade does not risk more than 2% of your total account value on that particular trade. Now, most of the, for example, if you're thinking about selling a credit spread, generally speaking, we're not selling credit spreads and holding them to expiration. So you might sell a 45-day option, and if the trade starts to work in your favor in about 10 days, you might close out that trade and open up a new one in 10 days later. So rarely would you hold a credit spread all the way through expiration. And as far as your concerns about transaction costs, transaction costs have never been lower. It is virtually negligible to trade equities and options from a transaction cost perspective. And especially if you use liquid symbols and OptionsPlay, on the OptionsPlay platform, there's a liquidity ranking for each symbol that you're looking at. If anything that you're trading, first of all, I think you should prioritize trading only liquid symbols. But when you do, you should be able to get filled pretty much either at the midpoint or within a penny or two off that midpoint, which would, again, further reduce transaction cost of getting in and out of a trade round trip. And I'll take one run here at the Uber play, because that was my play on CNBC last week. I do think that the Uber run here is a bit exhausted here to the upside. Do I think there's further upside into that 33 level? I think it's possible, but my preference would be to start taking profits after this run. The thing we have to remember is that Uber is still unprofitable. It is, revenue was better than expected, but that earnings actually came in a little bit worse than expected. So from my perspective, I'd rather fade this and take your profits if you did get in that Uber long.
And I did have one question that came in just asking about Rick's process. So there is a video out there, and I sent it to Nick who asked it, but I'll put it in the chat for everyone. That just really goes over his process.
And I think we'll be hosting some more on that front in the coming months. I've been doing a lot of research, not on trading, but on psychology. And Rick, I know you've done a lot of work on behavioral finance and kind of how that, why people buy at market tops and sell at market bottoms. Why do people go into casinos knowing that the expected outcome of that is negative and it's skewed against them? And there's a lot of interesting research on this front, and I'm really excited to share some of that with all of you, and how you can potentially use that information to your advantage and think differently, think contrarian the way that Rick does, to hopefully help, again, put that edge in your favor. And I think with that, we will cut this for today. We've gone almost a full hour, a little bit over than we thought we were going to, but I hope that this was helpful for everyone viewing this today. This was extremely insightful for myself. I learned a lot, and I hope that those of you watching here today did as well. And with that, we'll sign off here today. We will send you both the slides and the recording, and hopefully, and you'll see the trade tomorrow morning on AT&T from Rick. With that, thank you so much and have a great afternoon.
Thank you, everyone.
Thank you.